Hello guys, welcome to the video lecture on Introduction to Accounting. So our topic in today's video is on depreciation accounting. In our previous videos, we already have discussed about the concept on journal, ledger, trial balance, cash book and petty cash book. Those were the elementary part of our discussion with respect to Introduction to Accounting. The details of the video links are there in the video description as well as in the playlist of this particular channel. In today's video, we will be discussing on what is depreciation, methods of depreciation, and journal entry relating to depreciation. Now, depreciation is defined as a gradual decline in the book value of an asset. That means it is a decline with respect to the fixed asset. It's due to the wear and tear, obsolescence, or reflection of time. That means more you use the asset, the value of the asset falls over a period of time. It came from a Latin word which is known as depretum, which means de means decline and pretum means price. So depreciation is applicable to all fixed asset. With respect to time, the value of an asset will fall. Broadly speaking, there are various methods in depreciation, but the most two common methods are straight line method and diminishing balance method. The straight line method is also known as original cost method or fixed installment method. If the rate of depreciation is not given, the depreciation of an asset under a straight line method can be calculated with respect to this particular formula, which is equal to cost of an asset minus scrap value divided by the lifetime or the lifetime of a fixed asset. Scrap value means a residual value, the value of an asset at the end of the life. That is what is termed as a scrap value. Let's take an example. If the value of the asset is 1,25,000 and say the residual value after 10 years is 25,000, then it is calculated that the amount of depreciation every year will be 1,25,000, which is the cost of the asset, minus the scrap value, which is 25,000, divided by the lifetime of the asset, say for example 10 years. Therefore, the amount of depreciation is rupees 10,000 every year. On the other side, diminishing balance method is also known as reducing balance method or written down balance method or written down value method, is calculated on WDV, which is written down value, which is book value minus depreciation every year. Let's understand both the methods with reference to an example. It's given that the value of the machinery, that is a book value, purchased on 1st of April 2015 is rupees 10,000. And the depreciation rate has been given 25%, and we will do a comparative study with respect to both the methods, straight line as well as diminishing balance method. Since the asset was purchased or the machinery was purchased on 1st of April 2015, for the first year, we find the depreciation amount of 2,500 is same for both the method. It is calculated on 10,000 at the rate 25%. So the value of the machinery as on 1/4/2016, that is next year, is 7,500 under both method. Now here comes the difference. Under straight line method, the amount of depreciation remains same or fixed. So every year, irrespective of whatever the WDV is, every year the depreciation amount will be 2,500. Whereas in case of diminishing balance method, as we said, that it is calculated on the WDV, that is a written down value. And the written down value for 1/4/2016 is 7,500. Therefore, for the next year, that is from 1/4/2016 to 31st of March 2017, depreciation will be calculated on 7,500 at the rate 25%. Which comes to 1,875, which means that the value of the WDV of the asset as on 1/4/2017 is 5,625. For the next year, that is from 1/4/2017 to 31st of March 2018, depreciation will be calculated on 5,625 at the rate 25%, which comes to a figure of 1,406 as the depreciation. Therefore, WDV is 4,219 as on 1/4/2018. For the next year, again, the depreciation is calculated on 4,219 at the rate 25%, and therefore the depreciation amount is 1,055. Therefore, we see that in a straight line method, the amount of depreciation remains same, whereas in diminishing balance method, depreciation amount for every year has to be calculated on the WDV or the written down value. Let's understand the difference between the straight line method and the diminishing balance method. So first point is that for every year the amount of depreciation remains same for straight line method as we explained. But in case of diminishing balance method, we see that every year the depreciation amount is less compared to its previous year. because your WDV value also falls, and that is the reason why every year depreciation also falls. The next most important difference is, in a straight line method, the residual value of an asset can be nil or zero. But in case of a diminishing balance method, the residual value will never be zero. There will always be a residual value if you are applying a diminishing balance method. Let's understand the journal entries which are associated with depreciation. First, when the asset is being purchased either by cash or by check or else on credit, we know the journal entry will be the asset account debit or fixed asset account debit to cash or bank or creditors. That means you have purchased an asset, as per real account, asset comes in, so fixed asset has to be debited, cash or bank or creditors has to be credited. Now reverse will be the entry when you are selling or disposing of the asset. So it will be cash, bank or creditors will be debited to fixed asset when you are selling this particular asset. Kindly note, we haven't discussed about the point that if you are selling an asset, there might be a profit or loss on sale of an asset. That will be discussed in the later part of our video. The third important point comes is how we record depreciation. So depreciation has to be recorded with respect to the fixed asset because it is charged against the fixed asset. Therefore, the record of depreciation will be, the journal entry will be depreciation account debit to fixed asset, and kindly note that this entry will be repeated every year on the closing date of that particular year. Depreciation being a nominal account, being a loss, has to be debited, and since your value of the asset falls, so real account goes out, has to be credited, so fixed asset has to be credited. So depreciation account has to be debited and your fixed asset account has to be credited. The last most important point comes, the amount of depreciation requires to be adjusted with profit and loss account on the closing date. This is what we require to do in depreciation accounting. So since it's a loss, it has to be transferred to profit and loss account. So any profit or loss a business earns has to be transferred to the profit and loss account. So the journal entry will be profit and loss account debit to depreciation account. Let's understand these journal entries with reference to a particular problem or an assignment. The depreciation assignment states that B. Banerjee purchased a plant for his business at rupees 75,000 on 1st of April 2010. So the purchase price is rupees 75,000 and was purchased on 1st of April 2010. So you are informed that the scrap value of the plant will be rupees 5,000 at the end of the 10th year. So 10 years is the life, and the scrap value or the residual value will be rupees 5,000. You have been asked to show the necessary ledger account for 4 years, assuming accounts to be closed on 31st of March every year. Now when we talk from the point of view of necessary ledger accounts, we require to open up both machinery as well as depreciation ledger account. So if we have to calculate the amount of depreciation which is not given in this particular problem, so we know the formula, it will be the cost of the asset minus the residual value divided by the lifetime of the asset. Therefore, it will be 75,000 the purchase price minus 5,000 which is the scrap value divided by the lifetime of the asset which is 10 years. Therefore, we get a depreciation amount of rupees 7,000. Now how we proceed? So we open up two ledger accounts. One is a plant account or the asset account which has been mentioned in this particular problem, and the second is a depreciation account. We have been asked to open up the necessary ledger accounts. Therefore, we have opened both plant and depreciation account. As being said, on 1st of April 2010, B. Banerjee has purchased a plant cost valued rupees 75,000. So the journal entry will be plant account debit to bank account. So in plant account, plant ledger account, we have posted two bank account on the debit side of plant account with the amount of rupees 75,000. Step 2 is that we know that this asset has been used for the next 4 years. So after completion of the first year, that is from 1/4/2010 to 31st of March 2011, we require to calculate depreciation, and we already have calculated depreciation which is an amount of rupees 7,000. So the journal entry will be depreciation account debit to plant account. Therefore, in the plant ledger account, it will be by depreciation account rupees 7,000. Similarly, in the depreciation account, it will be to plant account rupees 7,000 because the journal entry is depreciation to plant. So depreciation moves to plant account on the credit side, as well as plant moves to depreciation account on the debit side. Once we have posted the depreciation entry, the next thing comes, do we have any sale? No. we don't have any sale of an asset in this particular year, so we close. So first we close the plant account. We find the total of 75,000, which is on the debit side. Thereby we get a balance of 68,000 as on 31st of March 2011 to be transferred to the next year in plant account. Similarly, we also close the depreciation account, which has a balance of rupees 7,000, and we said the 7,000 rupees has to be transferred to profit and loss account. The journal entry is profit and loss account to depreciation. Therefore, in depreciation ledger, it will be by profit and loss account, depreciation transferred, amount of rupees 7,000. Kindly note, it has to be on the closing date of the year, which is on 31st of March 2011. Now let's move on to the second year. Now in the second year, we already got a balance of 68,000 from the first year. So we transfer that particular balance as on 1/4/2011 to balance BD, 68,000. Now we move into the second year. Similarly, in the second year, we also have a depreciation amount. So we have deducted depreciation by depreciation on 31st of March 2012, 7,000. Similar entry has been passed in the depreciation ledger account to plant account 7,000, since the journal entry is depreciation account debit to plant account. Therefore, depreciation is recorded on plant account credit side and plant has been recorded on depreciation account debit side. Third part, we don't have any sale in this particular year, so we can close the ledger account. So we close the plant ledger account where 68,000 is the balance on the debit side. We get a balance of 61,000 on the credit side. We transfer it to 1/4/2012, which is the third year. Balance is 61,000. Similarly, we close the depreciation account, ledger account, because we have a balance of rupees 7,000 for the second year depreciation. So we transfer the second year depreciation to profit and loss account as on 31st of March 2012. By profit and loss account, depreciation transferred 7,000. Likewise, we will be completing the third year and the fourth year with respect to plant account, and we get a final balance of rupees 47,000 as on 1/4/2014. Similarly, if you check the depreciation account, every year the amount of depreciation of rupees 7,000 has been transferred to profit and loss account. We have done it for 2 years. Similarly, for third year as well as for the fourth year, depreciation required to be transferred to profit and loss account. I hope you have understood the basic concept of journal entries relating to depreciation and how it has to be reflected in the respective plant account or the fixed asset account and the depreciation account in depreciation accounting. Till then, thank you. Have a nice day.